Room is getting crowded. We're doing good here.
Excellent. Welcome, everybody. This is Sandra with Trading Made Simple, and today I have Rich Thorne on our program today. He's going to be talking about the wheel strategy. Rich is a guest instructor for us. He's so patient and kind for being with us every single day to answer questions about the strategy that he does on his portfolio. He manages his, he's retired, he manages his own large portfolio, and he practices the wheel. He often talks about it, and I find it fascinating. And when everyone is asking him questions about it, it just makes me wanting to know more about it. So Rich, introduce yourself, and let's get going.
All right, thanks, Sandy. Hello, everyone. That was a good introduction. I think I would. I think I would maybe add that it's going to be more than just the wheel. I have basically two strategies that I deploy. I want to get people to think maybe a little bit differently about how to generate income off of your portfolio. I am really a long-term dividend investor. So just real quick, just to trying to give everyone perspective, this past December, I sold out of everything. I worked for the Federal Reserve for years. I've been investing since 1990, and I'm on record. You can go to some Discords and see where I said I knew the Fed was going to tighten.
Setting that said unmute audio.
The speaker's microphone.
Yeah, Rich.
Can you all hear me all right?
No, Rich, you're going to have to mute that.
See the speaker's microphone.
Everybody on Zoom, if you could please mute your mic.
Let me see if I can do that. Looks like everybody is muted.
Yeah,
Weird.
I think it just took place. So great.
They are,
All right.
They are.
Well, long story short, I sold out of everything. I knew the Fed was going to tighten. And so what I've been doing is I created a spreadsheet of stocks that I wanted to own long-term. There's nothing better than getting paid while you sleep. So I basically have right now I have around $2,600 a month coming to me from dividends. My goal is to get that up to $6,000. I still have a significant amount in cash. And what I've been doing with that cash is I've been selling cash secured puts to get into long-term dividend positions. Okay. And so I have two strategies that I wanted to talk about. The first one is when you own a long-term portfolio and you want to sell cover calls strategically on that. So that's not really the wheel. Yes, it's true that I might have sold a put to get into that position, or I might have bought the share straight out, and I have plans to eventually sell cover calls. But I really wanted to start with Caterpillar here. And hopefully everybody can see this and let me know, Sandy.
Yes,
but this is
great.
Really a very good example of what I do. So I own Caterpillar. I own 100 shares, so I'm not built out yet completely. I want to own 200 shares of this long term, but I do own 100 shares at $180. And last week, as you can see here, the stock shot up because of earnings, and it got up to 219. And I immediately went out to May of 2023 and sold one covered call, and I collected $710, which basically meant I doubled the dividend yield, which on 100 shares is $480. So I basically turned a dividend stock that pays 2.25% dividend into a 6.6 yielding stock by selling one covered call. It's very passive. I'm done with it. And Sandy and I were talking today, that $710 is a done deal. I don't have to manage it. The stock can go up, it can go down. It's mine. I literally would transfer that into my checking account. And
no risk.
No, there's no risk, because if the stock, and by the way, let me show you what I did. Hopefully this, well, I'm not going to I'm not in the right account. I'm not going to throttle back and forth because I don't want to show numbers, but basically I sold it at 260 up here. And as you can see, I sold above resistance. This stock has never been at 260. So if the stock keeps going up and it gets called away at 260, then I make $8,000 because I bought it at 180 and I get $710 of the premium. So I basically have a 48% return right there. So I don't care if the shares get called away. And I personally, I don't think the stock will go to 260. But one of the things about having a long-term dividend portfolio, you want to rebalance. I don't have any one of my individual holdings that represent more than 5% of my overall nest egg. So if this stock continued to take off, it probably would get to the point where it would be potentially above 5%. So that's really where I would want to rebalance. So that's the great thing about selling a covered call. There's no risk. That's money, and I basically doubled, more than double the dividend yield.
Wow.
So
when you talk about, levels on your chart as an example, so because we're traders, where are you getting those levels from? How are you doing your analysis there?
Yes, great question. And let me show you. I spent a lot of time with this because I'm a long-term dividend holder. So if we went back and looked at this stock, you see this red line right here?
Mm-hmm.
I draw long-term trend lines. I'm a big believer in them. If everybody knows right here, hopefully you can see my cursor right here.
You can, yes.
This is basically pre-COVID. This is post-COVID. Look at this run-up. Now, this isn't really as bad as some of them. You go look at Roku and Snap and some of those crazy stocks. That kind of move made no sense at all. But the reason why I'm saying is I actually always go back and I draw where the long-term trend line of a quality stock, and Caterpillar, by the way, is a quality dividend stock. It has a long history of not only paying a dividend, but increasing its dividend every year. So what I do, Sandy, is I go and I do long-term trend lines. And then I look at support and resistance levels. And again, I look at it longer term because I'm not really a trader, I'm an investor. So we can see kind of, this is resistance area. You could say that probably here at pre-COVID that this is support level. That's where my long-term trend line is. The other thing that I do is I rely on Morningstar and 4 other services, Reuters, CFRA, and Argus reports, and they do discounted cash flow analysis to determine what the fair value of the stock is. So I also look at that. So when I sell my puts to get into my position, I look at all of that. I look at the fair value of the stock, I look at support, and I draw these long-term trend lines. And look where I got in at Caterpillar. I got in at first 172, and then I bought a few more shares at 180. So my average cost is 180. And then now here we are at 218.
Wow.
Now, the one thing I want to mention real quick, when you're a long-term dividend investor like Warren Buffett and others, you don't really care about unrealized losses. I know a lot of people have trouble with that. Your account, believe me, I've been investing since 1990. Your account balance is going to fluctuate. What I love about the fact that I'm going to get paid every month, it doesn't matter if Caterpillar's trading up here or if it's trading down here. I'm going to get a dividend payment. Now, I will say with the market pullback, why I sold out was I'm going to be getting these stocks at a discount. But we did talk earlier real quick. McDonald's is an example. Look at McDonald's, everybody. I bought McDonald's here, down here when it actually was right here. I'm not going to buy McDonald's up here. I want to own 200 shares of McDonald's long term, but I'm not going to buy it up here. So what I'm saying is I'm going to be strategic. I'm going to wait to get into these positions. And in the meantime, I'm going to generate income off of it by selling puts. And every month or every time it makes sense on a down day, I will sell puts and generate income until it gets to the level that I want to buy it at.
So, Richard, can I ask a question here?
Sure.
In Caterpillar, you didn't. You said you have 100 shares now, so you didn't buy all 100 shares at one time.
No.
Okay. Can you give us some logic? I realize you're selling puts to generate income in the meantime, but can you tell us how you choose to buy just a few shares for someone who says, "Oh, gee, I've got to buy 100 shares no matter what I do"? Explain your method there.
Yes,
please.
Jay, that's such a great question. Sandy and I talked about that earlier today. One thing that I have learned this year, and this surprised Sandy maybe a little bit, is even though I'm selling puts to get into these positions, it's hard to get assigned. So I have tried to get it signed on Caterpillar at the price I wanted all year long. But here's the thing that a lot of people don't understand about how options work. Let's say, like, if you sell a put on Caterpillar, say you sold it like right here at 240 and it went down here. That doesn't mean you immediately get assigned. It has to stay down there by the expiration date. See how it shot back up? So that's what was happening to me, Jay. I kept trying to get assigned, but the stock would always recover before my expiration date. So what I started doing was, to make sure that I get invested, I had to buy shares little at a time as well.
Oh, okay, great.
That's great,
I
because,
hope-
you know, typically traders, you know, when we hear assignment, you know, that just kind of freaks everyone out. And so here's a different mentality where you actually want to get assigned because you want that inexpensive assignment of those shares. And yet, when expiration, it just pops right above it. And so you don't get assigned. That's interesting.
That's right. And I will say I have two strategies here. So I'm talking about the first one. What this one is, on my long-term dividend portfolio, I sell calls strategically. I don't sell them every month. I don't sell them on every stock. I own 26 individual stocks across all the S&P 500 sectors. And one of the reasons why I want to own individual stocks is I want to turn a 4% overall yield for the portfolio into a 6, 7, 8% yield. You know, on a substantial amount of money, you're going from $6,000 a month to almost $9,000 a month.
Wow.
But my point is, I also do the wheel, and we'll talk about that here in a second. I consider that a completely different strategy. And I will even add on to that, some people do sell puts, Sandy, to your point, not really wanting to get assigned.
Right.
And we can talk about that too. And that's when you'll have to roll potentially to generate credit and to stay away from that assignment. But on some of these, I absolutely want to get assigned. And just to give you an idea, people are like everyone kept saying, well, aren't you worried that you put all that money in cash and you're not getting paid? The market could go back up. Well, I have made $40,000 this year selling cash secured puts to get in these positions. So you can make money doing this. So
are you still back to Caterpillar? So since you're buying just a few shares at a time, are you using the dividends that you receive or the money from the puts to buy that rather than your capital?
You know, yeah. I mean, indirectly, I am. You know, there are people that will sell a put and then, you know, make $200 or $300 and then use the proceeds from that to buy shares. And yes, technically I am doing that because I've made quite a bit of good income on Caterpillar before I even owned it. I think it was like $500. So yeah, you can do that. Real quick, I brought up IRM because this is another quick example of one where, see how it shot up here? And I sold strategically, because this is my long-term portfolio, two cover calls out to April 2023, and I collected $333, which again, on 100 shares, it's like $275. And this is not a very expensive stock, as you can see. So I basically then turned a 4.9% dividend yielder into a 12% dividend yield by just selling this one cover call, or two. I had two on here.
And you just let them sit there. You don't. You're not closing those positions out. And
by the way, I wish I was in the right account, but you see a red line right here at 60. And so look what I did. I sold that cover call to above resistance levels, where it's more than likely not going to get taken out. But if it does, Sandy, I'm fine. My cost on this, I think I bought it at $33 because I bought it back in here, you know, during the post-COVID. So I would be fine selling the shares at 60 and then keeping all that income. But no, I don't manage them. I want to be passive.
Wow. You know, because oftentimes you're posting your trades on your channel, and well, you know, I'm always checking them out. I'm like, wow, it just seems like you do a lot. How do you keep it all straight?
Yeah, that's where I have a spreadsheet, and I do. I mean, I have, like I said, I have 26 individual stocks that I could potentially sell cover call strategically. So I do have a spreadsheet, but I do also have alerts I put on. I watch all that. One of the questions Sandy asked me is how much time do you spend in the morning I will spend an hour or two in the morning looking at charts and looking to see if it's a good time to sell a cover call. I'm always aware of earnings dates because, you know, your stock can take off on earnings. That's how I was able to sell that cover call on Caterpillar so quickly, because the earnings were, I had an alert that I knew earnings was coming up, and sure enough, it shot up. So I spent a couple hours in the morning. It really isn't as hard as you think. One of the reasons why this year stocks are down, right? So I'm not selling cover calls on all these 26 stocks right now. So in fact, let me just real quick before we shift gears, let me pull up T. Rowe Price here. This is a good example. Look at my long-term trend line here, everybody. So this is a great stock, a great company. It's a mutual fund company that's old school. They're starting to make some adjustments, but this is a dividend aristocrat, which means it has not only paid dividends, but increased its dividend for 25 consecutive years. And I'm getting a 4.5% dividend yield on this. But the reason why I brought this up is, would I sell a cover call here on it right now with it being down here? No way in the world would I sell a cover call on this, because it could get taken out. The only time I would sell a cover call on it is if it shot back up here above the moving averages, then I'd sell one maybe up in here. I hope everybody can see that.
Yeah, because you're really just practicing old school support and resistance.
Yep. And look at the trend line.
Yeah.
You know, I think anything below here is a good buy for T. Rowe Price. So I don't want to sell a cover call here and get it taken out after spending all this time to get built out. And I'm going to own about 300 shares in this one. When it's all said and done, I own 150 right now.
But you would sell puts here.
I do have a put on it. Jay, I'm glad you brought, I have 105 put on it. Am I panicked? No. I want to own T. Rowe Price at 105. My premium I've collected, my break even, believe it or not, is at $98. But yes, I do have a put on it, and I hope I get assigned, and that expires in about 44 days.
You know, I think to the average trader, you know, it sounds so confusing. And how long did it take you to like really grasp, you know, just the terminology as well as the strategy to, I guess, manage the positions? Whenever I think about the wheel, I feel like it's overwhelming for me. It's like, it feels like, you know, you're constantly doing something and trying to figure out where the best places are to, you know, sell and
well, maybe
shares. And I guess, you know, for the average trader, we're not used to buying shares. We're not used to, you know, getting put, being assigned. And so I guess these are kind of like foreign almost.
So this may be that's a good question. I'll answer it. This is maybe a good transition now. So I've been talking about a dividend portfolio where I strategically sell cover calls. Now let's talk about, I also have a portfolio that's in my portfolio margin account, as you can see up here, where I am just strictly doing the wheel. And I'll explain what I mean by that, because I do think there's a difference. And it took me, Sandy, I've been investing since 1990. So this whole concept of understanding fair market value and fundamentals and quality companies, that's all kind of second nature to me. I was a finance major, but learning options, I think it does take a little while. I think it took me 6 months to really grasp everything. I think maybe what's more important is you got to develop a plan, a trading plan, and a strategy. I hopefully clearly laid out that I created a spreadsheet. I had a plan in place and I followed it. I had already identified every stock I wanted to own and what price I wanted to own them at. So you need to follow your plan, but it does take a little while. Because there are so many different ways you can use the wheel.
Right.
And so let's transition maybe to what is the wheel and how you can use it, even in a smaller account, to generate income. And this is a good example of one. This is the sector fund. This is XLC. It's the telecommunications sector fund. And I own 200 shares, and my capital in it is only $10,000. So I want everybody $10,400. And I have been generating $300 a month selling 2 cover calls on this. And I'm doing the wheel on it. And so what does the wheel mean? When I say I'm doing the wheel, that means I look to sell a put, and let's just use this one example. I got assigned up here like at 55.50, and then I sold a put at 48 and got assigned. So my average cost is $52.50, and I've been selling cover calls ever since and averaging 300 a month. And so I am getting assigned, and then I am fine having the stock called away right at the money. This strategy, in my opinion, is all about generating income. Yes, you can reinvest that income back into the account and grow it that way.
Right.
But I want everyone to understand, this is an income generating strategy primarily. So I've taken basically $10,400 and have generated $300 a month by selling cash secured puts, cash secured puts. I actually call them naked puts in a portfolio margin account. But I got assigned, then I turn around and I'm selling cover calls above the cost basis in this example here.
Wow, that's a lot of money for a small account like that every month.
It is.
I think that's great.
It is. Now, what's the risk with the wheel? Maybe we talk about that. What I have seen is people selling puts on crazy stocks like Roku and Snap. And I hope I'm not stepping on anybody's feelings about those stocks. But I'm just going to show you real quick. Let's pull up Roku. This is a scary chart. Look at this. Here's post-COVID, and look at that run up. You want to sell a cash secured put, you sell a put here, and then it comes way down here. I mean, look how far down you'd be below the cost basis. This thing was up at $400, and now we're at $51.
Wow.
Because of the crazy run up. So don't sell. You want to sell to do the wheel, believe it or not. You want to sell it on quality dividend stocks like Coca-Cola, Pepsi, McDonald's, Walmart, the sector funds, the indexes, because they're not going to get away from your cost basis as much. Okay. These crazy growth stocks can really get away from you. Now, let's go back to XLC. Now, with my account, I have a rule where I don't want any one of my positions to represent more than 5% of my account. So you might say, well, Richie, you're right here, but look, this thing post-COVID could come down here. So I've left myself room. So scale into a position if you have the capital to do it. In other words, I have 200 more shares. I'll build out 400 shares with this, which would be right around $18,000, $19,000, well below my personal threshold. And I can sell 4 cover calls all day long in this range and probably make $600 a month doing it. On $18,000, $19,000 invested.
Wow.
So what I'm saying is that I scaled into this because I got assigned here.
Right.
Then I got assigned here, and now I've left myself room down here to get assigned too. 400 shares at an average cost of $45. And this is the telecommunications ETF. Look at the trend line on this thing. This thing's, in my opinion, it'll continue to go up. So that's what you want to do the wheel on. Quality companies that are going to be around, that aren't going to get away from you, that you can literally generate income by selling cover calls.
So most of us, when we go into our account, and we see that it's red as an example, we're looking at that, and we're, especially as traders, sometimes we trade our P&L. Tell us about that when you're doing this investment.
Yeah, I'm glad you brought that up, because for dividend investors, long-term investors, and for even options traders that are doing the wheel, that are doing it for income, we can stomach fluctuations in our account balance. It's all about the income that we can earn. In other words, we're looking at that. We're saying capital, that portion of the cap, go out and earn me some income on it. So I don't really care. Like, I hope everyone notices here, XLC, I have an unrealized loss in it right now. I'm at 52.50 and it's at 45. I am not worried one bit. I'm not losing sleep. I don't have gray hair, and I'm generating $300 a month on it. In a year, if you want to be technical, I'll have my break even probably down below 40. But I don't really, I look at it as a way to generate income. But Sandy, you bring up a good point. If you are the kind of person that cannot, if you're a true trader where you where all your money is in and out and you don't want to have anything exposed to the market overnight, then doing the wheel is probably not for you, because there isn't anybody that's ever done the wheel that hasn't had an unrealized loss in it. That's just part of this strategy. So I hope that answers your question.
Some of us have had unrealized losses and we're not long-term traders.
Yeah. Well, everybody does. Yeah.
But I am not a math whiz, but it sounds to me like that's almost a 30% or over a 30%.
34%.
Yeah.
Yep.
And that,
It's shocking.
yeah, it's pretty shocking.
That's what
I will say that
trade.
I don't do those kind of returns on my long-term dividend portfolio where I sell cover. I'm just looking to double or triple my dividend yield. But in the wheel, that's what I wanted to show. Doing the wheel, you can make a lot of income. You want to know why? Because you're selling cover calls at the money, right at the money. You don't now Microsoft. Now there are times where I'm doing the wheel, like I'm doing the wheel right now on Microsoft. I will do it out of the money, which means I'll make money on the shares going up. That's really a great strategy too. But what I'm saying, there's flexibility with how you do that with the wheel. But yeah, you can, Jay, Sandy, you can generate those kind of returns that you're generating as traders by doing the wheel. You can generate 30, 70% type returns.
So it's possible that everybody's just their mind's kind of exploding the way mine is, but there's no chats in here. So guys, do you have questions or comments on what's going on here? Because I can't be the only person who's kind of surprised.
I'm blown away.
Yeah.
Because, I'm one of those people that have, an IRA floating over here and over here. And it's like, I keep saying, okay, I'm going to take that IRA. I'm going to, I need to get those things together and, do something about them. But yet I'm at my computer every day trading. So, who's
Rich,
out there that's like that?
Yeah, here's a question that says, would you recommend these income generated strategies for someone who is still 20 to 30 years from retirement?
That's a great question. The one thing I will say is that, my daughter's 26, and what I would potentially do, and now and that person can come back. What I would probably do is invest in dividend growth / dividend stocks. And there's ETFs that do that for you. I'll give you a quick example. You might think Johnson & Johnson's boring, pays a 2.7% dividend. But if you started investing dollar cost averaging right now into Johnson & Johnson, did you know that $10,000 invested in Johnson & Johnson 30 years later, without the share price really changing a whole lot, but you just keep reinvesting those dividends, went from $10,000 to $300,000? So the S&P 500, if you look over its history, 65% of its return comes from reinvested dividends. So to answer that question is, I think you could invest in income generating stocks like Home Depot, Microsoft, Apple, that will pay you income. And you're going to, at that age, you're going to reinvest those dividends, right? But in 30, 35 years, you're going to have accumulate a lot of shares by reinvesting those dividends. That's first and foremost. At your age, you could take some capital out and do some of the wheel strategies to generate income and then just reinvest it and grow the account that way. So you can do some of those things, but typically what I would recommend for someone young that's planning for the future is to get into just some really good ETFs and dollar cost average into it. And that's how I was able to build up my nest egg.
So Rich, Dave is asking, do you have monthly dividends? Or I guess you could also look at what you just showed us with the telecom, that even though it's not a dividend, it's monthly income.
Yeah, it is. But to answer the question is, I have 26 individual stocks, and some of them do pay monthly, like Realty Income. It is by far the best real estate REIT out there. It's a dividend aristocrat. It pays over a 4% yield, and it pays monthly. I have cover call ETFs that I'm a big fan of that pay out monthly. And so maybe just real quick, for those that are nearing retirement or close to retirement, there's cover call ETFs out there that are basically doing what I described my first strategy is, where you have a portfolio of stocks and you're selling cover calls strategically. You can actually buy an ETF that does that for you. The best one out there, in my humble opinion, is Divo, DIVO, or JEPI, JEPI, and they pay out monthly distributions. They own a basket of individual stocks, quality growth paying dividend stocks, particularly in the case of Divo. And then they're strategically selling cover calls, and they will pay you monthly distributions. And the yield on Divo is 5% annually. And on JEPI, it's been crazy. It's been well over 11% this year.
Wow. Wow.
And it pays you. So I'm getting paid every month $400 a month on owning JEPI. But I prefer Divo because Divo is going to outgrow JEPI. The total return on Divo is going to exceed it because it sells it way out of the money cover calls, and it only does it strategically. But the point is, you can choose what's best for you.
Right.
So Tangleweb says there's a guy in his mid-20s on Instagram who was an elementary school teacher who retired by doing the wheel.
Yeah.
So,
Yeah, you can look, you can make tons of money on it, but I just want people to understand there's risk to it, to the downside. And
Tell us about that.
I have a large account, so I scale into my position. That's what I wanted to show here. I left myself room because look, if I was looking at this stock doing a long-term trend line, I would say, you want to be right around in here. But there's the unrealized loss standpoint. You could get so far below your cost basis that you don't feel comfortable selling a cover. You can't sell a cover call and generate any income above your cost basis. So what do you do in that situation if you don't have any more shares to add and you're well below your cost basis? Now I'm going to tell you something that I have actually done is it's okay to sell a cover call below your cost basis. Why? Because stocks are falling. You can generate significant income on it while stocks keep falling. If the stock happens to go back up, you can roll up and out and collect more credit and get above your cost basis eventually. So please, for those people out there that are told, don't ever sell a cover call below your cost basis, I don't agree with that, particularly in a market where it's fallen like this. So just keep that in mind. If you get caught in a position where you can't sell above your cost basis, like there are a lot of people in PayPal right now that are in that situation, it's okay to sell a cover call on it below your cost basis. It's not as though it's going to come up and take you away. I mean, look at PayPal. You can see the analysis I did here. Look way up here, guys. People were buying up here and selling puts here. Now look at the stock. So if you're caught here, say you're at 185, say you got up here because you thought this was support, you could sell a cover call here, right? And still generate income. Has the stock gone above that? No, it hasn't. So you can sit there and make a pretty good income by selling below your cost basis. And then what happens is you lower your break even.
Gosh, for some of us, it just seems so confusing, doesn't it? But like someone asks, can you walk us through selling a put on Amazon or Apple like you did today? Why did you pick those two?
Okay, great question.
Was it to get the shares assigned?
With Amazon, it was. So look at Amazon. Look at my trend line on it. Now you're thinking, good Lord, Richie, you're pretty conservative with that trend line. Well, you want to know why? The run up here after COVID, up here, then it kind of stabilized. And Amazon, by the way, if you put $10,000 in Amazon in 1995, you'd have $35 million right now.
Yeah.
Now, I don't think that Amazon's going to keep doing that, but I don't think Amazon's going anywhere. I think it's going to be fine. But my point is with this long-term trend line, I was pretty conservative with it. I could have taken it up here and put it up here, but I wanted to be conservative. I even went below the moving averages, as you can see. And I am right here. So I sold a put on Amazon and got down to 89. I believe, was it 89?
it
Doing that
was
from memory.
Yeah.
And the reason why is because I have plans to accumulate 300 shares in this area right here. And then guess what I'm going to do, which is what, if Pam's listening, if you have 300, even if you have 100 shares, I'm going to have 300 shares of Amazon that doesn't pay a dividend. So I don't love Amazon, right? It's not a dividend stock, but now watch this. If I get 300 shares of Amazon right here, I could go out to June of next year and sell a cover call, 3 cover calls at 100. So I now have made 300 times 20. What's that, right? Because the difference between where you bought it, 300 times 20 on the shares, you're making right there $6,000, and you can collect probably $6,000 of premium. So you've just turned a non-dividend paying stock in 6 months' time. You make $12,000 on it with three cover calls. I looked at it.
Sure.
With one, it might be a little bit less than that. But my point is you can go out in time and sell out of the money on Amazon, not at the money. I don't want to sell at the money because I think it's going to go up. I think long term it's going to go up. So I would go out 6 months, sell up 3 cover calls and collect and lock that money in. That's $6,000 that I would transfer right to my checking account. I'd be done with it.
And no risk to those covered calls.
No risk. If the stock keeps falling, what can I do? If the stock keeps falling, I can take those cover calls off, probably to 90% profit, and put them back on if it comes back up again.
That's just
and then instead of making 6,000, I make 12,000 on the premium.
So walk through this slowly again for those who are mentally impaired.
Oh my gosh.
So they
we need to learn how to do this.
Yeah. So today the stock was 89, and if we sell the covered call, you're saying it at 100. Then is that correct? Or
yeah, how are you picking that?
So the reason why I did that, and that's a great question. I am going fast. I apologize.
No.
So I want to be sure. I think I might have sold the cover call at 81 on it. If not 89.
You did. No, you did 81. Yeah.
Yeah, it was 81. Okay.
Yeah.
So
yeah, we've been talking about you.
So right here, I have a plan to accumulate 300 shares. Why? Look right here, guys. I'm going to go ahead and draw a little horizontal line here. Right there. I'm below what I think is pretty good support there. But I wouldn't mind owning 300 shares here. And the way I chose 100 is that I make $6,000 on this stock. Forget about the premium. Because if it goes from 80, 81 up to 100 on 300 shares, that's $6,000, right?
Mm-hmm.
But I can also collect, and the way I chose that, Jay, is I went out and I saw that if I sold 3 cover calls, and I would love to show everybody on the option chain, but I can't do that because it's going to show some information I don't want to be seen, my count numbers and stuff like that.
No, that's fine. Yeah.
But basically, I could collect $6,000 5 or 6 months out, and that's a done deal. So you literally could say $6,000. That's $1,000 a month you just made. You just locked in $1,000 a month on Amazon,
right?
By selling 3 cover calls out to June. You potentially could make 12,000. So the way I chose it is I wanted my premium to match what I was going to make on the shares. That makes sense.
It does.
So I collect 6,000 in premium. I can make 6,000 on the shares. That's $12,000 in 6 months.
Sounds good.
Yeah.
And so I'm curious. So, an average person that's, got these floating IRAs like I do that needs to be rounded up and paid attention to. Let's say you got like $30,000 or $50,000 that's floating, around that you're not really doing anything with. It's probably invested, but it's, nothing that you're keeping track of. What would you do with that money?
Yeah, I think where you're headed is that you could do the wheel. If you had $30,000, $35,000, $50,000 and you wanted to open up a margin account, you'd have to be careful with it, but that would be enough money where you would get really good margin on that. And you can sell puts on that money without paying margin interest, which is beautiful. So that's what I would do with it. I would probably pick a handful of quality stocks like Walmart. For people listening, in my opinion, on a good down day, Walmart is a great stock to sell puts on. So just pick quality stocks, and you can pick maybe with 30,000 to 50,000, have some risk management in there, some share size. Maybe you spread that across 3 or 5 stocks. I personally wouldn't put all of that in one stock, but I know people that do that. They'll build out a position of $30,000, $50,000, and then just wheel that. And
you're only managing 3 to 5 stocks with that.
Right. And you could do one, but there's just, in my opinion, putting all your nest egg in one stock,
Yeah,
or
that's
even
not a good idea.
if I was going to do that, I would do the indexes, by the way. If you want to take $30,000 or $50,000 and put it all in one thing, because you can make really good income on doing the wheel, I would pick like the indexes to do that. I would not, like I said, I mean, look how conservative I am. None of my individual holdings, including my ETFs, represent more than 5% of my total portfolio balance. So I'm pretty conservative with that. So, everyone has a different risk tolerance, but
So
you could do that.
Tangleweb is asking, would you use something like the SPY?
Yeah, I do SPY all the time. SPYs, in fact, can I show this to you real quick?
Yes, of course. You
So
have plenty
SPY,
of time.
look right here. What does that say? Buy ride strategy.
Mhm.
So see this blue line right here? I already have it designated. So if the stock market, where we're up here, some are predicting that we're going to fall below pre-pandemic highs, which is over here. You see that right there? That green line right there is, I put that in as a pre-pandemic. In fact, I have a put on right now, by the way. But at the green line, I'm definitely going to start selling a bunch of puts there. And then if it gets this blue line, forget about puts. I'm going to buy about 700 shares, and I'm going to go out 6 months, and I'm going to make about $45,000 to $50,000 and lock it in. Why? Look at the long-term trend line on the SPY. I'm comfortable buying 700 shares, going out 6 months, and selling cover calls 6 months out and locking that income up. I mean, it's way below the long-term trend line, and I've got 5 stocks here. So that's a strategy that I like to do, because then you, and I would only use like $40,000 in buying power to do that, by the way.
The rest is margin.
That because I have portfolio margin. Now I know a lot of people don't have that, but at $300, say 700 shares, that would normally be $210,000, right? If my math is right, on 700 shares. Well, I only get charged. I take that back. It wouldn't be I'd only get charged about $21,000 to put that trade on. So now I've locked in 45,000, or probably around 25,000 with premium, and then another 25,000 with the gain in the shares. So I've locked in. Now I've got 2,500 a month basically coming in me. Now I can do the wheel and other stuff and continue to make income, but I've locked that income in.
When you say buy right, have you used that term? What is that, buy right?
Okay, so all that means is that you buy shares. I'd buy 700 shares of the SPY.
I see.
Then I'd immediately turn around and sell a call on it.
Got
7
it.
calls on it. Now I might wait a week for an up day.
Sure.
But what you're really doing is you're buying it with the intent to immediately sell cover calls on it to generate that income. And like I told you, if you're selling cover calls the right way, that's a done deal. You should be able to put that money in your checking account and be done with it.
And use it.
Because there's no risk. When you sell a cover call, there's no risk. But I see traders all the time panic.
Yes.
Oh my God, I'm going to get taken out. Well, then you should never have sold a cover call on it.
So Dave wants to know, what are your moving averages and how you determine the trend line?
Yeah. So what I do is exactly. So as you can see this trend line right here, you can see the moving averages. I'm pretty conservative because I think this run up post-COVID was not normal. So that's why I have my red trend line going below. Like I could have taken it. I know I have a lot on here. I could have taken it right here and gone this way, right? But I didn't. I went this way because I think this run up was overdone. I kept telling everybody, it's quantitative easing. It's the Fed Reserve. I was part of those discussions at one time. This is not normal. This action.
What is that? The blue one is 200. The red is 50, and the purple is 100.
Yeah, I'm sorry. You were asking what 200. Yeah, so I have the 200, I have the 50, and then I have the 100. But the long-term trend line, I drew it pretty conservative below the pre-pandemic highs. Because
you're just doing that by hand, by
I'm just drawing what makes sense.
Oh wow.
And then I look at fair market values. Now with the S&P 500, you can't look at a fair market value, but I look at the PE ratio. And the PE ratio on the S&P 500 down here is like, I think most people would say, yes, buy the S&P 500 all day long if it gets down to this level.
And for those of us that don't know what PE ratio is,
price divided by earnings of the company. price of the stock. So that's one of
Yeah,
the
us
things
traders,
from a,
we don't even.
yeah, I mean, and you don't have to, if you're a technical trader like Sandy, and so many of you are you're better at that than I ever will be. You're technical. I mean, I'm a technical trader, but in a different way, but
Mhm.
you're really good day traders. You don't have to worry about PE ratios because you're not owning the stock overnight.
Yeah.
But if you start doing the wheel, you want to choose quality companies. It doesn't mean you need to be able to understand their PE ratios, but you want to, I mean, everybody knows Walmart's not going anywhere. McDonald's isn't going. Sell on quality companies is all I'm saying.
How do you get approved for a, just a portfolio margin? Is that really about a balance that you have to keep and achieve there, or?
Yes, great question. It's very difficult. So you have to have at least $100,000 in the account. Some brokers require a lot more than that, 125,000, 150. Every broker is a little bit different. For Charles Schwab, it was $100,000, and then they put me through 3 different sets of interviews. I had to meet with 3 different people, and they literally listen to me on this. They literally told me horror stories about how people destroyed their lives because they went out and got portfolio margin, and they used all of it, and they destroyed their lives, their families. So they wanted to make sure, number one, they understood my strategy, why I wanted portfolio margin, because it's significant. I'll be transparent here. I have $350,000 in this portfolio margin account. Guess how much buying power I have with that? Well over $5 million.
Oh my gosh.
Now you understand. I could go out and sell puts and naked calls, which by the way, I would never do, where basically I would have a net neutral position. I could have $5 million in notional value out there and just bring in income left and right. And believe me, people do that. But that is crazy. I would never do that. I'm very careful with it. It is, but it is nice having it because you can take advantage of pullbacks like this. I can buy 700 shares here. Of course, I have enough cash to do that, but I mean, I could get assigned in other positions up to $600,000 and not even have a margin call. That's the beautiful thing about portfolio margin, or even margin in general. You just got to know how to use it.
But we want to know, can you sleep at night when that happens?
Yeah, I couldn't do it. I mean, I would never sell puts totaling 5 million. In fact, just so you guys know, I just told you I had $350,000 in there. My notional value. And what is notional value? If you added up all of the puts, all of the positions I have on, what cash would it take to buy those? It would never exceed, in my case, $500,000. Because you get, I don't want to get too technical here, for $350,000, you get your stock buying power, and just a normal margin account, just a normal one, would be $700,000. But I would never have my notional value go above 500,000 with that. So I'm pretty, and I don't even use that. I usually only have like 150, 200,000 at the most at one time. I'm pretty conservative.
I kind of like that.
Yeah.
Because I am too.
I'm not trying to make 15,000 a month.
Right.
I'm trying to make somewhere between 2,500 and 4,000 a month. Right. I'm in this account. So
somebody asked, how do you check AROC and AROM for a given position? And I don't know what those acronyms mean. When I document my trades, if it's I have 4 accounts. I have 3 retirement accounts and 1 portfolio margin account. In my margin account, I will have annualized return on cash and annualized return on margin. And margin basically means how much capital they required me to have to put on the trade. And it was much less than what it would have been if it would have been in a retirement account, which is completely cash secured. So all I do is let's just go, quick example, a $300, excuse me, a premium divided by 30 days, say it was the 30-day expiration. I multiply that by 365, that's $3,650. Maybe it may be that the cash to do it was $18,000. So that's basically what I'm doing. I'm taking the amount of premium you receive and I'm annualizing that over 365 days, dividing that by the capital that was required from cash, and then in the case if I did it in a portfolio margin account, what the margin requirement would be on it. I hope that makes sense. You're
it's not
blowing
hard.
my mind.
Yeah.
But someone asked for small accounts, step one is to buy puts to generate income in order to sell.
Sell puts,
Okay.
sell puts.
Oh, okay. So step one is to sell puts to generate income in order to sell covered calls.
Yeah, you want to sell puts, and then you hopefully get assigned. If you don't, by the way, if you don't get assigned, which I just said earlier, it could be hard. You just keep collecting that premium on the puts.
Right.
Just keep doing it. And then once you get assigned, then you turn around and you sell cover calls. It's a great strategy, but it's a strategy with risk, especially if you're doing it on crazy stocks.
You know, it just seems almost like the math like overwhelms me, you know, when you're talking about how to do it. I would love to do like a, we're talking about doing a challenge in our futures channel. I'm wondering, you know, for those people that are out there that have $30,000 to $50,000 floating around in these IRAs that they don't know what to do with, after they get them honed in, would you be willing to walk us through like a challenge where, you know, like you said, you take 3 to 5 stocks a month and you can generate income? And how much income you said for like 50,000?
You saw on 10,400, I'm generating 300 on that one. You know, I really think a good way to start with this is like those sector funds I talked about.
Yeah.
Like XLC, believe it or not, I think would be a good one. It's not that expensive. You know, Walmart, those kinds of things.
Right.
But yeah, we could do that. We could simulate it, and then
that's a great idea.
The one thing I haven't said this maybe enough, you only want to sell puts on down days or when the VIX is up. When the VIX is over 30, that's the volatility gauge of the market. When the VIX is up, that's when you want to sell a put, because you get more premium that way. You get more premium. Yeah. And then so if when the market pulls back, typically the VIX goes way up, and then that's a perfect time to sell a put. You can get safer in case you do get assigned. And then if you do get assigned, then you can turn right back around and sell a cover call. And I typically, you know, will choose and we haven't talked about this. You know, I choose a delta of about 20, which basically means you have an 80% chance that the stock won't be assigned to you. It's just the inverse. So if you sell a 20 delta, that means you have an 80% chance at the time you sell the put that it won't go to your strike price by that expiration date.
So Richie is at Trading Made Simple, and he's there every day answering questions for free. You don't have to be a subscriber of any service. You just come on into our Discord. Richard is there for free to answer any questions. We're gonna do a challenge. I want to simulate a $30,000 to $50,000 account. We're going to take 3 to 5 good dividend yielding stocks, and let's see how much income we can generate each month and get good at what we're doing. And then maybe do something about those damn floating IRAs and get them honed in so we could start doing this for real. Because I can't tell you, I talk about it forever. Like I have all this stuff, and I know I'm not the only one.
Well, real quick, I didn't mention this. One of the reasons why you want to do a dividend stock is if you do get below your cost basis, you're going to get paid a dividend. Right. So, you know, that's the nice thing about it.
So Rich, just a hypothetical here. So Amazon, I'm fixated on it, but if we got 100 shares of that, we're talking $90. I'm sorry, $9,000.
Yes.
I just looked up. If I sold a $100 call in March, it's going to generate $600.
Yeah.
So that's $100 a month, which is about 13% a year.
Yep.
And then if it goes to $100 and I get stopped out, I've made another 24%.
Exactly. And by the way, Jay, you did that not on an up day. Could you imagine if the market reversed on an up day and then you did it?
Yes.
It'd even be better.
Yes.
Yeah.
So,
yeah. You got it.
I'll probably do it tomorrow then.
Yeah, it's fantastic.
Oh my gosh. I'm just blown away.
Well, gosh, I just really want to say thank you so much, Rich. every day people are asking questions and you're so thoughtful to always answer them. And not only that, but you post a lot of trades to get people to, just to get them thinking about the wheel strategy. And I have to tell you, there's just like me, I don't know really about futures. I don't know about the wheel, but these are things that, you kind of wish we would learn in finance in school and stuff. I think kids would be, young adults would be way better off in their 20s or 30s getting into their first career and trying to figure out, how to invest, what's my best options. And like you said, there's even ETFs that do this for you if you didn't even want to even think about it.
Real quick, I know we got to sign off, but I'm glad you mentioned that, because I just don't want to ever be in a position like in retirement where you have to rely on selling shares to pay the bills. Could you imagine if you had to sell shares in this market? So that's the one thing about these ETFs you just mentioned, Sandy, these cover call ETFs, and you're going to get paid a dividend no matter what the market does. And as long as you're diversified, you don't chase yield, you're going to pick quality, you're going to get paid. So just everyone out there, think about that. When you get close to retirement, don't rely, or at least consider relying on dividends versus selling shares. People get in trouble that way. We've had lost decades. Between 2000 and 2013, the S&P 500 was down. So you're going to be selling when the market's down to pay the bills. So just keep that in mind.
Got a lot of positive comments about a lot of thank yous, and people are looking forward to doing stuff, things like that. And then Tyra says you're selling puts because you think the price is going up.
Yeah, yes. Well, yes, the most people will sell puts because they're bullish. I think that's yes. But then someone like me, I wouldn't mind if they went down there and I bought it. But yes, yeah, that's usually that you want to sell puts on stuff that you believe is it's either going to go up or stay the same, or maybe go down a little bit, but maybe not to the point where you get assigned, because there's a lot of people that don't want to get assigned.
Yeah, I always find it fascinating. On our bullish days, you're selling puts, and I'm always looking at your comments, and I'm like, because that's the time when all of us traders are like, we're looking at all our long positions and getting excited because for whatever reason, going long makes us feel comfortable. And so, we're starting to strategize with our butterflies and our calls. And then I look over at your channel and you're like selling puts, selling, or excuse me, selling calls, selling. You're always doing the opposite, it seems.
Well, I typically sell cover calls again on really big up days, and then sell puts on really big down days. But this is what confuses people with me. Sometimes I want to own that stock. So I will sell it right at the money, and maybe it might not make a whole lot of sense to y'all, but I'm trying to get paid to own something that I want to own anyway. So just keep that in mind.
When you're posting that, do you ever say that I want to get the shares?
Yeah, I do.
Good.
I used to do that all the time. I haven't as much recently, but I used to because people are always saying, wow, you're going to get assigned. And I'm like,
what are you doing? You're like, hey, I want to get assigned.
So Sri is asking, do you mind sharing a favorite ticker list? If you don't mind, you'll just put that in your channel tomorrow. How's that?
Yeah, we actually have you have a list of stocks as well as ETFs that you have on the pyramid. Maybe we'll post that in Discord. People can come take a look at it for free.
Yeah, definitely. I could post what I think are good stocks to do the wheel on, and stocks and ETFs to own if you're looking at doing that. It's a great way to, even if you're younger, to generate income and reinvest that and accumulate shares. It's
and if
amazing.
Nothing else, get your simulated count in order, and let's just follow along for 3 to 6 months and figure out how this goes, because sometimes the math is overwhelming for me. And I
know I go so fast too. I'm sorry.
Yeah, you just have it like so quick. And for whatever reason, I can trade, but when it comes to the math, I'm like, what?
Well, you got to remember, I am actively managing my portfolio, so it's all on my it's on my edge of my tongue. So
right. So maybe a group of us can get together, simulate it, and then we can, go through the motions. Sometimes when you actually do it hands-on, it's visual, you're listening to it, you're doing it muscle memory, and then we can finally get a kind of a rhythm. How long did it take you to get that rhythm where, it seemed natural to you? Because clearly it's natural to you.
It is, it really, what the game changer for me wasn't really the concept of selling a call and a put. I think most people can figure that out pretty quick. But what changed it for me is having that strategy. This is what I'm trying to accomplish. So it took me a good 6 months. Once I figured out, hey, the Fed was going to start tightening, I knew that, hey, I want to get invested. I'm getting out of all this. And then I created a trading plan, and I'm literally following it. I mean, you can see these notes I make. I'm literally following my plan. So I think for everybody out there, it does take practice and experience to get good at it. But you think about what you're trying to do. So many people sometimes will buy a stock and they don't even know why they bought it. They don't know if it's a swing trade, excuse me, or a day trade, or if it's for a long-term hold.
And they don't keep track of it either.
And you got to think about why you're doing something. And I know that sounds simplistic, but you got to have a trading plan in place. Like, I didn't panic when T. Rowe Price dropped on me, because I know it's a dividend aristocrat and I bought it for the dividend. So you got to think about what you're doing. So that's helpful, I think, is when you develop a trading plan and you follow it.
Well, this hour just flew by.
It did.
Yeah. Sorry.
Thank you so much. Oh,
Thank you, Richie.
no,
We're going to
it's
ask
great.
you a lot more questions in Discord. If you want to talk to Richie for free, just come on over to our Discord, Trading Made Simple. You want to get the Discord address. I don't know if I have it posted anywhere. It's tradingmadesimple.org is the Discord at the homepage. And come talk to Richie. He'll answer your questions. He's just a great educator and instructor, and he just does this because he wants to teach other people how they can improve their lives. And thank you so much, Richard.
Thank you.
We really appreciate it. We'll see you tomorrow. Thank you, Jay.
Okay, have a good night.
Good night, everyone.
Good night, everybody.